Okay, well, hello everyone and welcome to Module 5 review. Tonight we're talking about financing options, all the different methods that you can finance properties. Lesson 1 we looked at the more conventional route, and then Lesson 2 the less conventional or the non-conventional financing route, and we wrap things up with the most creative lesson, which is the vendor take-back or seller-held financing. So we'll go through this relatively quickly, and we'll then get to, I've got a few questions here that were sent in earlier, and if anybody has any questions on the call, by all means go ahead and ask those as well. All right, so finance options. Conventionally, it's your banks, credit unions, and your mortgage brokers. The non-conventional method is your own personal cash, lines of credit, which is like cash, retirement funds, whether it be your RSPs or 401ks, joint venture partners, private money, whether you're borrowing through mortgage brokers or using other people's money, and then vendor take back and seller financing, which wraps things up for the non-conventional. So with respect to conventional, there's the big banks, and these big banks are probably what 50–55% of the population continue to use rather than using mortgage brokers. Not sure why that is, whether they just have this trust for the big banks, or I'm not exactly sure why, or just lack of education or knowledge about the mortgage brokers. In the United States, the big ones, and there's many, but this is just an example: JP Morgan Chase, Bank of America, Citi Financial, etc. In Canada, it's what they call the Big Five: RBC, Bank of Montreal, CIBC, TD, Nova Scotia. Now, all of these, doesn't matter which country they're in, they're heavily regulated by the governments. These are owned and controlled by the shareholders, which is why they're so focused on profits and generating profits for the shareholders. They're not concerned about you, the borrower or the depositor. They're more interested in generating profits for the shareholders. The nice thing about the big banks is that they operate right across the country, so it doesn't matter what state or province you're in, you can borrow from one side of the country to the other, and even across the border. So if you're a Canadian investing in the US market, there's some Canadian banks that are well recognized down in different regions of the country as well. RBC, Scotiabank, TD are all located in different regions of the US market. Same thing if you're an American investing in Canada, you can use those same banks and just open up an account in the Canadian branch in the US market, and then it just makes it easier to do the banking business when you cross border. Why is this not going here? There we go. Now, credit unions are very similar to banks. They look and feel like a bank until you actually step in and start talking to the people, because you very quickly realize it's a different mindset mentality inside the credit unions. And again, these financial institutions are all across the country, but they're not necessarily linked all across the country. They're much more isolated. So you could have credit unions throughout a state or a province, but if you want to go to the other side of the country and use that same credit union, there may not be a branch out there. They may not be able to help you. So that's one of the downsides. The nice thing about them, though, is that they're owned by members, and therefore, and it's usually local people in the community and whatnot that started these up years ago, because the big banks weren't there to help them, so they created their own banking system. But because they're owned personally, then, or more personally, they're not as driven to generate profits, because they are actually for non-profit. Therefore, they're more limited services as well, lower fees, higher returns, which is good for you if you're borrowing or investing there. The nice thing about them also is that they can create their own policies. So if you've got a unique opportunity to buy something, it just doesn't fit in conventional pigeonholes, the credit union won't turn you down outright. They'll put it towards the lending committee and see if they would consider it for lending. continuing on, so when you're dealing with the conventional lenders, you're going to have to meet their criteria with regards to the debt service. So one of the criteria is the gross debt service, which is your annual mortgage divided by your gross family income. They're looking for a 30% maximum, so if it's above 30%, you're not going to qualify, so they're looking for below 30%. If you've got more debts than just your mortgage, then they're also going to add in all of these other debts, so that could be your student loan payment, could be your credit cards, it could be your car payments. So they'll add up all of these debts divided by your gross family income, and the threshold now is 40%. So again, if it's higher than 40%, they're not interested in lending. It has to be under the 40%. And then this is debt coverage ratio is more applicable to the commercial mortgages. What they're looking for here is to see that the debt can be serviced by the income from that property. So if the ratio is 1.2 or lower, then they don't believe that the earning capacity for that property is strong enough to support the debt. So they want to make sure that the debt service ratio is 1.2 or higher. Real estate and mortgage brokers. The reason I've got real estate brokers on here is because mortgage brokers are similar to real estate, how they operate. So a real estate agent cannot buy and sell or represent clients on their own. They have to represent their clients through a real estate brokerage. So it's the real estate broker who is licensed to operate the office and is responsible for all of the transactions that all of the real estate agents perform. It's the same thing with the mortgage broker. So you're most likely going to be dealing with mortgage agents, not the broker themselves. And the agents are regulated, or they're watched closely by their mortgage broker of record, the person responsible for their license. With the mortgage agents, you have to recognize that 95% of the agents are going to be focusing simply on residential mortgages, the simple ones, the straightforward mom and pop going out and buying a house and applying for a mortgage. The reason being is that over 95% of all mortgages across the countries are residential mortgages. It's a very small percentage of the mortgages are actually commercial mortgages. So as a result, you have very few agents specializing in commercial mortgages or with private lenders. So you need to be aware of that just because you go to a mortgage broker doesn't necessarily mean that they're going to be the right broker or agent to work for you or with you. The agent receives a commission similar to a real estate agent. They're paid by the lender. So the lender will compensate the mortgage brokerage financially for bringing them a customer. With the commercial mortgages, the commission may be paid by the lender, but not likely. They may pay a small commission, but the mortgage agents, they charge more for commercial mortgages because there's a lot more work involved, which means that cost is then going to be passed on to you, the borrower. The agents also have, or mortgage agents also have, access to many different lenders, and this is a big advantage that they have over the banks. Banks will only have access to one lender themselves. They may be willing and able to go outside of the bank for one or two other options. They are starting to do that in order to compete more with the mortgage agents. But generally speaking, the mortgage agents have this unfair advantage where they can shop your application around to many different lenders, keeping their focus though on the top 3 or 5 lenders, because they become familiar with them, they know what they're going to do for them, they can count on them. But there's also something that you may want to be aware of, is that the commissions that are paid to the agents from the lenders can vary, and what you want to make sure is that your agent is putting you right into the right mortgage for you, to benefit you and not to benefit them simply because it pays a higher commission. I'm not suggesting that all agents do that, but I do know that some agents are aware of that, and that becomes part of their criteria. Mortgage brokers also have access to private lenders. Not all of them, but the ones who've been around for a while will have access to private lenders, and these are high net worth individuals who are looking for other places to invest their money other than just the stock market or the bank. they'll approach a mortgage broker and lay out their criteria and say, I'm willing to lend X number of dollars in first, second, or third mortgages. However, this is what you need to ask for and get back from the borrower. So you can definitely expect some higher upfront fees. The person who is lending the money, the investor, is going to be looking for a couple points up front, and what that means is when they lend $100,000 through the mortgage broker to an individual, then there's a $2,000 fee. That's called 2 points, or 2%. Then the mortgage agents are going to need to be paid, so the mortgage brokerage will charge 1 to 4%. So let's say it's another 2%. That means there's $4,000 worth of fees in order to access that $100,000. Plus the interest rates are most likely going to be a little bit higher, and they charge a little bit higher because they know that you wouldn't be coming to them unless it was a difficult thing to finance, or else you'd be going to the conventional bank. The other thing that, they may or may not be as stringent about qualifying, but generally speaking, they will want to see credit reports, etc., job verifications, similar to the banks. But there is no magic threshold of only 80% loan to value. They could potentially go to 100%. It's rare, but they could, providing there's enough value in the property. So when do you actually go from conventional into the non-conventional? Well, these are just some of the examples. If you've got a limited down payment or cash available, poor credit scores, and just moved to a new area, so you've got a new job or no job, your credit ratios are slightly out of whack, you need to refinance quickly to access instant equity, or you want to do 100% financing. So the non-conventional, as I said before, is your personal cash, lines of credit, retirement funds, joint ventures, privates, and VTBs. Now, you're getting into the world of potentially raising capital as well, and I can't stress this enough times. Make sure you are familiar with the Securities Commission and what the rules and regulations are in the area that you're investing and raising capital. You don't want to start advertising, anywhere in the general public looking for investors, guaranteeing high returns, because you're just inviting the Securities Commission to come in and slap you. So make sure you understand the difference between accredited and non-accredited, and this is something you want to sit down and discuss with your lawyer if you're going to start raising capital. Just quickly, an accredited investor is an individual who has assets worth $1 million, and that's without any debt on it, or if there's debt on them, the assets have to total $5 million. Or it could be an individual whose net income before taxes exceeds $200,000 annually, and has been for the past couple of years, and expect to moving forward as well. Or if one individual doesn't have $200,000, but a couple, individual and a spouse combined, their income exceeds $300,000, then they would be considered an accredited investor as well. Accredited investors are considered to be financially literate and capable of affording investment losses. That's why you don't need to be as careful with the accredited investors. The non-accredited investors, the mindset of the government is that these people are not accustomed to investing large amounts of money. They're not educated with respect to the risks, and they can't afford to lose large amounts of money like the accredited investor can. So then we've got the cash. I say here cash is king. Well, cash flow is actually king, but having access to cash is a really nice benefit to have, because it allows you to go in and negotiate at a different level. What you do need to keep in mind, though, is highest and best use for your cash. Having 100% of your cash tied up in one single property is not likely the best use of your money. It could be the best use to buy it, but you definitely want to pull as much of that cash back out and put it into another asset and get it moving, turning that money over and over. It's called the velocity of money. Lines of credit is simply having access to cash that's not yours but secured by one of your assets, whether it be your own personal credit worthiness or your house or another asset like your house. If it's a secured line of credit, the interest rate's going to be lower. If it's unsecured, meaning that it's just secured based upon your word and your ability to pay it back, then the interest rate's going to be higher. The big thing to keep in mind here is that this is not a mortgage. A lot of people treat it like a mortgage. They'll use it for long term on a one particular asset. The challenge is that it's also better known as a demand loan or a demand note, and that means that the banks can call that in at any time without any without much notice. You know, within 30 days they could call it in. They could change the interest rates. They could change the terms. They can do all kinds of things that they can't do if it was a conventional mortgage. So just be aware of that. With credit cards, I never recommend that you use your credit cards for anything other than day-to-day necessities. Always pay your credit card off completely at the end of the month. Do not carry balances. If you have to carry a balance, make sure that the balance you are carrying is less than 60% of the credit available. If you carry more than 60%, then the credit bureaus are going to look at you as being irresponsible with your money, and they will penalize you by giving you a lower credit score. By carrying no balance, paying your debt off at the end of every month, that is the best thing that you can do to help improve your credit worthiness very quickly. Retirement savings funds, whether they be RSPs or 401s, yes, you can use them for mortgages, but they have to be in a self-directed fund. So you may have to liquidate them, put them into a cash fund, and then put them into a self-directed fund where they will allow private mortgages to be held. You can do it for your own property. It's not wise though, simply because you can only go up to 80% loan to value, plus they need to be insured. So you're better off to leverage your money on other people's property, whether it be in a first, second, or third position. The nice thing about using RSP money with other people, especially people you know, you don't have to go through the qualifying process that you normally do with the banks, and you can also negotiate the rates and the terms being the big one. So you can negotiate low interest rate, you can negotiate balloon payments, you can negotiate interest only, all kinds of different things that you can negotiate that you would be hard-pressed to do with a conventional lender. Using other people's money, always highly recommend you doing this. I've got a 50-50 partnership shown here. It can be 60-40, 70-30, 10-90. It can be whatever the two parties agree upon. There's three basic ways of borrowing money. You borrow money where both you and the money lender are on title for the property, as in partners. You can also do it where you are not on title, but the money partner is, and then what you do is you just have a contract between yourself and the money partner with respect to how to run the property. Or it can be you on title and the money partner not on title. That one's a little bit more difficult because it's harder to show where the money's coming from to satisfy the bank's criteria. Mortgage fraud is something that is rampant out there, and it's basically just the deception. I mean, if you are lying to the lender about how much money you're making, how many properties you have, anything at all with respect to what they're asking, then you're misrepresenting yourself or deceiving the lender. That is technically mortgage fraud. Now, unfortunately, there's many mortgage agents and many representatives, even in the banks themselves, where they will suggest, oh, well, don't report that, or we'll beef that up, we'll just make this look a little bit better, or you're losing your job, don't tell me about that. Technically, that is still mortgage fraud, and just because the mortgage agent or the bank representative is telling you, it's okay, it is not okay, because you are the one who's entering into a contract with the lender, so it's you who's going to have to pay the price if you're ever challenged. All right, actually I just want to check something here. All right, I've got more people coming on. Good, thank you very much. All right, so now we get into vendor take-back and seller financing. This is where the creativity really takes off, and this is where a lot of people have challenges because they don't know how to structure it, they don't know how to approach people to ask for it, they don't know how to explain the benefits to the sellers, and that's what you need to learn in order to be successful with the creativity of this. All right, so get my mouse working here again. What exactly is seller held or vendor take-back financing? Quite simply, it's when the seller agrees to hold a portion or all of the money owed to them for the purchase of the property, and they will hold it in the form of a mortgage. This mortgage can be in a first position, second, or third position, so you could get conventional financing for 60%. You could then have the seller hold a second mortgage for 30%, so now you're up to 90%. And the seller held mortgage will be in second position, and then the balance 10% could be your own personal cash, or the seller could hold a third mortgage for the 10%. The banks may not like that the fact that it's financed up to 100%, so you might have to go down to about 50% with the bank. Usually when you get down around 50%, the banks don't care much what happens behind them. They don't care like what's in second or third position, because there's so much equity there to protect them. They're okay with that. The advantages to the seller with respect to the vendor takebacks, it can potentially increase their profit, because now they're also getting an interest payment on the money that is owed to them, which is going to be typically higher than what they would get if they were put it in the bank. They could potentially also ask for more for the property because they are giving this favorable term to the buyer to help them buy it. It will create a faster and easier sale, because now especially if it's if there's no conventional financing in place and it's just all vendor take back, then the buyer doesn't have to qualify for any financing. Therefore, it's faster and easier. You cut through all the red tape of the banks. It also then allows you to have shorter closing periods if that's of interest or value. You can negotiate favorable terms. So you can negotiate the interest rates, you can negotiate how the interest rates are being paid out, you can negotiate different terms and conditions within the mortgage as long as both parties agree. And then the seller, as sort of tied to the increase in returns, the seller can potentially ask for a higher asking price because of the they're making it easier for the buyer to buy the property. Some more seller advantages: the higher interest rate for their cash, definitely. So when they get their money, what are they going to do with it? They're probably going to stick it in the bank at 2% interest, or they could leave it in the form of a mortgage at 4%. So they can double their return that way. It also opens up the options to sell it to more people. So people who are a little bit more cash strapped, they are going to be more interested in buying a property with a VTB. It can also generate a monthly income. So I just did a deal with a student where he financed the property 80% loan to value with a vendor take-back mortgage, and the seller is an elderly gentleman. He didn't have any use for the money. He was just looking for a monthly income anyhow, so it creates a nice little pension income for him for the next 25 years. It can also potentially save on taxes, because when you sell a property that's not for your personal use or residence, there's going to be capital gains on that property. The capital gains is going to be due and payable in the year that you sell it. Now, if there is a capital gains exemption where you're only paying tax on 50% of it, but still, you can defer up to 5 years, or spread out, actually is a better word, spread out the tax payable over 5 years if you're holding a vendor take-back mortgage. So if you have a vendor take-back mortgage with a 25-year amortization, 10-year term, well, you can only offset the taxes for up to 5 years. So it doesn't work exactly this way, but think of it, you take 50% of your capital gain, and whatever that dollar amount is, 20% each year goes onto your taxable return instead of all of that money in the first year. So that potentially can save you some tax dollars. It's secured against a real asset as well, so that if you need to foreclose on it, it's going to be foreclosed on a property that you are familiar with, and the foreclosure process gives you that peace of mind. Some of the disadvantages, and there's not too many, you could end up with the property coming back to you. If you don't want it, that's not necessarily a good thing, but it's better to have the property come back to you if the buyer reneges on the contract or fails to make payments. You're not simply going to lose your money like in the stock market. At least here you do have an asset that you can chase down and claim back. You could potentially incur the expense of foreclosure, the lawyers, the time, and all of the reselling of the property, etc. And this is probably the bigger one, is that you could end up taking the property back in worse condition than what you sold it to them, so you may have to invest more money back into the property in order to bring it up to the value it should be at. From the buyer's perspective, the advantages are that you get to negotiate the terms and conditions, including your rate, your amortization, penalties, discounts. There's no lending limits, so you can go up to 100%. You can actually go greater than 100%, but nobody in their right mind usually would. You may not need to qualify like you would at a bank. So again, my student here recently, nobody asked for his credit report. If I was doing it, if I was offering a vendor take-back mortgage, I would definitely want to see the person's credit report. I'd want to see some history to make sure that they were legitimate and good individuals, but very few people actually ask for this information. You can purchase properties other lenders don't particularly like. So mixed-use commercial is a good example. A lot of banks won't go above 65 or 70%. Some banks don't even like lending on properties like that. So, and the sellers realize that their properties can be a challenge, therefore they will be more free to offer vendor take-back options. You can also use other personal items as collateral as well. So if you want to get a higher loan to value, say you wanted to get it up to 95, maybe even 100% of the purchase price, but to minimize the risk for the seller, you may have to put up another item. You know, maybe you've got another rental property with some equity in there that you could also use as collateral, and it's what they call a blanket mortgage then. Some of the disadvantages for the buyer is that you may end up paying too much for the property because you may have to pay a premium in order to have access to that vendor take back. Not always, but there is that potential. And you could become over leveraged. So if you start to pay too much for the property and then you finance it closer to the 100%, if and when you do get into your financial challenges, there may not be enough equity in there to bail yourself out, or if the property values plummet, if you were at 80%, you could afford to lose 20% of the value of the property before you become over leveraged. So just something to be aware of. Interest costs may be too much as well. So again, typically vendor take-back mortgages are in second and third positions, and as a result they do ask for higher interest rates. Now again, the one that I just did, it was in first position. The interest rate that we're paying is 4%, which is a little bit higher than what could get at the banks. Could get 2.75 at the banks, but the fact that he's able to get that high ratio, no credit checks or anything like that, is a bonus. Keep in mind that a mortgage is a legal document registered against the property detailing the terms, and this document, similar to a purchase and sale agreement when we talked about assigning a purchase and sale agreement, you can do the same thing with a mortgage as well. You can assign the mortgage to another party, or effectively sell that mortgage to another party. And mortgages are bought and sold every day. People don't realize it. Just because you go into your local big bank and you take out or you apply for and receive a mortgage from the bank, and you continue to make your payments, monthly payments to that bank, the chances are that bank is not holding that mortgage. What they do is they bundle together a group of mortgages, and then they'll sell them off to an investment group, and they will discount it so that they keep the bank makes a profit on the spread, because the banks, as much money as they actually do have, actually I don't think banks even have money anymore because they just push keys on the keyboard now. That's another story. Anyhow, they do not have unlimited resources at the bank, so what they do is they bundle them up and sell them off to other markets. And this is a big reason why the subprime meltdown took place in 2007, 2008, is because all of these subprime mortgages, the mortgages that were given out to people who shouldn't really have had mortgages because they were deemed to be high risk. They weren't flagged as high risk, therefore the mortgages got bundled together and sold to investment portfolios as being good risk investments. And then when they started to default, that's when the investors discovered that they bought a whole pile of bad mortgages, and it was like a house of cards that just started to collapse upon itself. So, question is, can you buy a mortgage or can you sell a mortgage? And quick answer, absolutely. I have done it. I don't go out and do it on a regular basis, but I have done it. So where do you go to do it? You can go to notemarketplace.com, which is an American-based platform. There is no place in Canada that I'm aware of that, just because we're such a small market. However, there are lots of private investors out there who are willing to hold mortgages. Mortgage brokers themselves will have, should have, some private individuals who would be interested in holding mortgages. There's actually some mortgage brokerages that only deal with private lenders, and as I said earlier, it's not necessarily the cheapest source of money to borrow from because they charge higher fees. But if you have a mortgage that's at a really good interest rate, they might be interested in buying the mortgage from you. Also suggest you go and speak with your lawyer and your accountant, and although they cannot tell you who would be interested in buying it, what you can do is share with them some details of the mortgage and just let them know that if they know anybody, could you just pass your name on to that individual, and if they're interested, then they can talk to you. I shared with you the campground sale as an example of how I created a mortgage and then sold the mortgage. I won't go through that in detail, but the bottom line is during that whole process, I would be what you call a unconscious competent, meaning that I did a very good deal, but I had no idea what the heck I was doing, and it just worked out, and I've learned so many lessons from that one sale alone, and fortunately, knock on wood, they were all really good lessons. Worked out extremely well for me. But the biggest lesson I learned was that I created an asset that was going to pay me a really nice amount of cash on a monthly basis, $2,900 a month for the next 25 years. But then I realized that this asset was what we call a depreciating asset. So in order to make better use of that money, because of course $2,900 a month coming in is just going to disappear unless you're extremely disciplined. Plus, it's going to take a while to build up $50,000, $60,000 in order to go out and buy a property with it. So what I decided to do, because I remembered from my earlier real estate days that you could actually buy and sell mortgages. So I did some research, and I discovered that I could sell the mortgage, and I had to discount the mortgage amount a little bit. So the original mortgage was $460,000. I discounted it by $35,000 to give the investor, make it a little more attractive to the investor. So in effect, the investor was making 7% return on their money. But the big thing for me was I had $425,000 cash that I could turn around and go out and invest, and I was able to take that $425,000 and buy several real estate transactions that generated more than $3,000 a month income for me. Plus, it was an appreciating asset instead of a depreciating asset. So in 25 years, I would have 3 assets completely paid off, earning me far more money than if I had that and just held on to that initial mortgage, because at the end of 25 years, I would have had nothing. So that led us into this scenario where you have a hard luck buyer and a motivated seller, and you've got a buyer who isn't able to qualify conventionally, and you've got a seller who's stuck with maybe a not so pretty house or whatever, and they're very motivated. So you strike up a deal where the property's worth $300,000 and the seller's willing to sell it for $250,000, and the buyer can afford to pay up to $2,400 a month. So what I did was I structured 3 mortgages that totaled 100% of the loan to values of the list price. So it's not overfinanced based upon the market value. So the 60%, 25%, 15% loan to value adds up to $300,000 in mortgages, 3 separate mortgages. You can see the interest rates there in the middle are 6%, 10, and 16%. And to make it attractive then to other investors to buy those mortgages, and it could be one investor buys all 3, or it could be 3 investors each buy 1. So the first mortgage was already attractive enough at 6%, didn't need to discount it. It's low risk. The second one, if you discount it by 10%, that increases the return up to 12%. The third mortgage, you discount it by $8,000, increases the return up to 20%. So in total, discounted all three mortgages by a total of $18,000. That means that I've collected $180,000 from investor 1, 65 from investor 2, 37 from investor 3 for a total of $282,000. I owe the original owner of the house $250,000, so I get to keep $32,000. So I've created a win-win-win scenario. So the seller's happy, the buyer's happy, and I'm very happy. Now, have I done this transaction? No, I have not. But it's a really neat concept to be introduced to, because it just opens your mind up to the possibilities, the potential that's out there. You can do it on 3 mortgages like this, or you could do it with 2 mortgages. There's no limit as to what you can do. So the clause that you need for this, the vendor agrees to carry a first mortgage of $80,000 bearing 7% interest. There's the monthly payment over 25 years, pretty standard clause. Then what you want to do is, you don't want to get stuck with this property. You've just created 3 mortgages. Those mortgages have to be sold. If you can't sell them, then you have to walk away from the deal. Just like when you buy a property and you have to get financing from the bank, if you can't get the financing, you walk away from the deal. So it's still conditional upon financing. The difference is that the financing is you selling the 3 mortgages. So here, for example, it's conditional upon the purchaser being able to sell the above-mentioned seller-held first mortgage at a minimum amount within 14 days. So now I've got 14 days to sell that mortgage. If I can't sell the mortgage, then I walk away from the deal. You repeat that for both clause number 2 and 3 with the clauses for the second and third mortgage. Now, you can also have other different strategies as well. So here we have a second mortgage for $20,000 bearing interest at 10%, calculated semi-annually, not in advance, blah, blah, blah. You put in the payment, 5-year term, 25-year amortization. Because that seller, the person who's holding that mortgage, if it's a vendor take back, the seller is holding that mortgage, he may come up to the same realization that I did and want to get rid of that mortgage so he can have his $20,000. So maybe he's willing to sell that mortgage for $15,000 to Joe Blow in order to have his cash today. He doesn't want to wait. Well, if I have this other clause, the purchaser will be given the first right of refusal to buy the vendor-held mortgage under the same terms and conditions he or she would accept from another purchaser. That means I have the right to buy that mortgage for $15,000. If I have the $15,000, I can buy it, and I just saved myself $5,000. And quite often when you're doing VTBs, it's not because you don't have the money, it's because you have better use for your money. So you're always trying to use other people's money. You can also structure it so that the vendor agrees to give the purchaser a discount of 10% within the first year or 5% within the second year if you pay the mortgage out early. So with that $20,000 mortgage, if on the 11th month I decide to pay it out early, I can take 10% off and pay it out with just $18,000, which means I saved myself $2,000. Vendor agrees to hold a mortgage in the amount of $50,000 over 30 years, 5 years term, 1 year interest free, or year 2, 3% interest, providing 85% occupancy. This is just to give you an idea of some of the creative things that you can do, because quite often, especially with an investment property, the seller will want to sell it based upon its potential revenues, yet it might only be 60% occupied. Well, you're going to want to buy it based upon the 60% occupancy. That's quite a spread. So maybe you come to terms somewhere in between, and what you do is you negotiate a vendor take-back mortgage. Could be a second or third mortgage, whatever the amount, and you say that if you're so confident that I can fill this place up within a year, then put your money where your mouth is, Mr. Seller, and I will have the first year interest fee, and once I get to 85% occupancy, I'll start to pay you 3%. Once I get it up to 95%, I've got no problem paying you the 5% interest, because it will cash flow at that point in time. So you can come up with different variations of that. Again, it's just to give you an idea. The vendor take-back mortgage shall contain a clause allowing the transfer of this mortgage to any person. So if you're planning to assign this contract with a vendor take-back clause in it, you have to have this clause in there, or else the vendor take-back clause is no good, because when you entered into a contract with the seller, it was between you and the seller for that mortgage, that vendor take-back mortgage. If you then turn around and sell that contract to somebody else, well, the mortgage is still between you and the seller, and that's not what you want. So you want to make sure that that mortgage, vendor take-back mortgage, goes with the contract to whoever you sell it to. You also want to have a subordination clause in the contract, and it's easier just to go through the little example here with the subordination clause. So let's say you buy a property, the after repair value is $400,000, but you purchase it for $300,000 before repairs. Your first mortgage, conventional mortgage, is $240,000. The seller lends you a $60,000 second mortgage. You do the repairs, and it's time to refinance that property, so you're going to go back and get 75% loan to value of the after repair value. That means you're going to replace the first mortgage of $240,000 with a brand new $300,000 mortgage. So you take out the first mortgage, and the moment that you take, the second that you take that first mortgage out, this second mortgage is going to slide up into first position. And then the new first mortgage is not able to slide into that place. So what you want to do is you want to put a subordination clause in. So what's going to happen is when it comes time to place that $300,000 in, because there's a subordination clause, what it effectively says is that the person holding the second mortgage agrees to stay in second position. So once that first mortgage is removed, it will remain in second position, and the new first mortgage can slide into first place. Buying and selling corporations, we didn't go into it a whole lot of detail, but there's definitely some benefits to selling a corporation. So for example, with the campground, it was a corporation. I sold it as a corporation. The biggest benefit for me, the seller, is that well, first of all, there's some tax-free benefits because it's considered to be a business then. But the bigger one is the liability, because when they buy the corporation, they're also buying the history attached to that that property as well. And it's not that there was bad things in the past, but one never knows. So I'm no longer responsible for any future issues that they discover. Also, if there was some improper tax filing several years ago, through no fault of my own, but just the same, the corporation is reassessed and they owe more taxes, well, the new buyer of that corporation is going to be responsible for them. So that's the downside of it. The upside for the buyer is that they're not buying a piece of land. So if you're buying this in a province or a state that has land transfer tax, there is no land transfer tax because you're not buying real estate, you're buying a corporation. Agreement for sale is simply a purchase and sale agreement that it has an extremely long closing. It could be a year or 2 years. So it's similar to the idea, the concept of a lease option, but it's a more formalized document, and it allows you to take possession of the property, run the property, but the title does not change, and the existing financing on the property doesn't change either. The original seller still makes the payments on the existing financing of the property, and you make payments to the seller, and it's just a different strategy. Again, it works in most provinces and states, but you would want to talk to your lawyer about this before making any use of that. So, and as always, anything creative, if you're not sure, I always suggest that you include, subject to your lawyer's review. It can be, you know, a very short clause, 4 or 5 business days, so that you have an opportunity to run it past your lawyer to make sure that everything you're doing is legal and proper. And that's it. So we'll do some Q&A here. If anybody has any questions, please feel free to ask away. And in the meantime, I'm going to respond to some questions that were sent in earlier. I'm just going to take a quick water break here. All right. Do I need to use a mortgage broker to borrow money from a friend? Okay, no, you do not. When you are borrowing private money, you can borrow between two individuals, and you can use your lawyer to create the lending documents, a mortgage document, because technically a lawyer is like a mortgage broker. They have the same capacity as a mortgage broker. So you can use your lawyer to facilitate a transaction like that. What I was talking about with private money and mortgage brokerages is that there are individuals out there who have large amounts of money that are looking for places to invest, but they don't know who you are. You don't know who they are. So the mortgage broker is the facilitator, bringing the two parties together. Are family members exempt from being accredited? Good question, because I don't think I covered that actually. I talked about what an accredited investor is. The people who are exempt from that are, of course, the high income earners, the high net worth earners, but also your direct family members, so brother, sister, and very close friends. So that's where it starts to get a bit gray, and it's sort of open to interpretation as to what is a close friend. What I have been told, and I have not seen this in writing, so don't hold me to this, but if you don't know the person that you're borrowing money with or doing business with, if you don't know all of their family members, like the children, and you're not invited to their house for dinners and special occasions, then that's not deemed to be a close friend. So there has to be a level of trust there. Why would I use a line of credit instead of a mortgage if it can be called in? Hang on. Why? If the line of credit can be called in, why would I use a line of credit instead of using a mortgage? Well, no, that's a good question. It's a fair question. Again, if you have use for the line of credit, like if you're taking a line of credit out of, say, $50,000 to use as a down payment on a property, then that's a good use of the money. You buy the property, then within a month or 2 months, if you can replace that line of credit with a second mortgage through somebody's retirement funds, then you pull that $50,000, $60,000 back out and you pay off your line of credit. That's good use of your line of credit. But if you leave your line of credit in that particular property and you continue to make your monthly payments on your line of credit, which is all good and fine, the issue is that the bank could call it in. And if the bank calls it in, how are you going to get the money out of that property quickly and easily? So there's a time and place to be using the lines of credit. It's great to have access to quick and easy money. That's perfect. You want to have that. It's good to use it for short periods of time, month, 2 months, 3 months perhaps. If it's going to be tied up for any longer than that, you may want to consider using a mortgage instead. Yeah. All right. Just check, make sure there's any questions here. Oh, a question. Let me get to the top here. It's a very small box, sorry. Okay. Why is using an RSP on someone else's real estate mortgage a better opportunity than using it on your own property? Okay. So you can use your own RSPs on your own property, whether it be your personal residence or whether it be one of your investment properties, but you can only go up to 80% loan to value. So you're still going to have to come up with 20% down. Plus, at least in Canada, I'm not 100% sure in the US market, but in Canada with the RSP mortgages, it also has to be insured. So you have to go through CMHC insurance to insure your own money to make sure you make payments on your own mortgage. It sounds silly, but they just don't want people to default and get out of the mortgages and avoid paying taxes. So it doesn't make sense to do it that way, whereas you can, as an example, so this is, who was this? This was Elliot. Okay, so Elliot, I could lend you, say you bought a property and you had $50,000 to put down on the property. You buy the property, and then a month, 2 months later, because there's good equity in it, you bought it below market value, I then agree to lend you through my RSPs in the form of a second mortgage $50,000. You place that mortgage against the property, you pull your $50,000 back out, and you can go buy another property. And the agreement is that you can, or you will, do the same favor for me. So at some point in time when I buy a property and I've got $50,000 or $60,000 down, a month or 2 months later, you will then through your RSPs against my property, allowing me to get my money back out, and I can repeat as well. Now, it would be best if you had 3 people doing that, because CRA, the government, consider it's not illegal, but it's a bit of a gray area because they consider that to be tax evasion, where in reality it's not tax evasion, but they just look at that a little bit funny. But that gives you an idea of why you would invest it in somebody else's, because you can go up to the 100% valuation then. Or you could even go up to the 90% valuation, but because you bought it below market value, you are able to 90% of the after market value price is going to be more than what you actually paid for the property. A little convoluted, but I hope I got it for you okay. Okay, so what happens with mortgage fraud? So I'm assuming that they mean if they are caught with mortgage fraud, what happens to them? Well, it depends on the degree of mortgage fraud. It depends on, well, I guess the severity of it. So if the bank finds out, for example, that you lied about your income, or you didn't disclose all of your debts, or whatever the case may be, you lied on the application, what will they do? Can they fine you? Are you going to go to jail? No, none of that's going to happen. What they could do is ask you to reapply, and they may say you no longer qualify. We're going to call the mortgage in, because they have the right to call the mortgage in because you didn't honor the contract. Now, if they call the mortgage in, you're going to be stuck with an asset that you have to get refinanced someplace else. So you may have to find a different lender that's going to charge you a higher interest rate. So that's most likely the worst case scenario. Now, if you go to the extreme with mortgage fraud and you start to overfinance a property, so you borrow more than what the property is actually worth, now you're looking at jail time. Now you're looking at some major fines. And that's what's happened in the past. There was a big one in Montreal, Ponzi scheme, mortgage fraud scheme. There was a big one in Calgary, I want to say about 7, 8 years ago. There was a big one out there where there was somebody within a major bank, there was an appraiser, and there was a lawyer, all connected, and there'd have to be more than one person doing this in order to facilitate this degree of mortgage fraud. So when it gets to that level, to that degree of severity, then yes, there's some major consequences. For you, the individual, though, who gets caught lying on your application, most likely, I can't guarantee it, but most likely what would happen, the worst case scenario, is they would call the mortgage in and you have to refinance it with somebody else. So I sort of answered this next one already. How easy is it to find someone to buy a mortgage? I can't say it's easy. I can't say it's difficult. It depends on your ability to network. So here's what you could do, though, is if you had a mortgage to sell, you are holding a mortgage right now and you're interested in selling it, what I would do is I would approach some of the more established real estate agents in your market and ask if they know of people who are interested and or willing in doing this. That's how I found my buyer of the mortgage for the campground. If that doesn't work out for you, then I would approach the lawyers and the accountants. They themselves might be interested in doing it, or just don't ask them. Put a little package together and say, this is what I have. If you have any clients interested in buying this particular mortgage, have them give me a call. I would also approach people in your own circle of influence, people like your doctor, your lawyer, your dentist, all of these high income earners. They are always looking for places to invest and park their money. Real estate clubs is another great source because, believe it or not, not everybody at a real estate club is there to invest in real estate directly. Some people are looking for opportunities to invest with other people, and by buying a mortgage is investing with other people. And then I would put as your last resource is to go to the mortgage agents or the mortgage brokers and see if they have people interested. The challenge there is that the mortgage agent or brokerage is going to want a cut of the action, so it could cost you some money there as well. And then the last question I have from the same person: why did I sell my mortgage for $35,000 less? Okay, well, I did talk about that a little bit here again. So this was a question that came in earlier. I'll just expand on that a little bit more. The reason I discounted or I sold the mortgage for $35,000 less than what it was worth is that I had to make it more appealing or attractive to the investor. So the mortgage document itself was paying out an interest rate of 6%. The investor said that he doesn't invest in anything less than 7%. Well, I can't change the contract. I can't change the mortgage contract. It is what it is. It's a legal binding contract for its term. But what I can do is I can accept less money than what it's worth face value. And for him to pay less, well, he was going to pay $425,000 for a $460,000 asset. He wasn't getting that $25,000 cash today. But what he was going to do when the mortgage is paid out in the end, he will receive $25,000 more than what he paid for it. So in effect, it's like getting paid 7% or 8% on that mortgage instead of 6%. So that's why that was done. So hopefully that answers that question for you. So that's all I have for my questions that were sent in. Are there any other questions here? We have gone over the top of the hour, so that's good. I talked pretty quick there tonight because I had a lot to cover in a very short period of time. All right, looks like that's it for questions. So that is good. Appreciate everybody being on the call tonight, and I know that vendor take back one is a lot to take in. You'll probably want to watch that or go over that video several times. There is a lot of information. I strongly urge you to go over that one several times because there's a lot of ideas, there's a lot of content in there, and I went over it very, very quickly here tonight. Yeah, just keep checking them out. Oh, hang on, I think. Oh, there was one question here, sorry. Okay, so this is further to the RSP question. Can I use my RSP as 20% down payment and 80% financed on my own property? No, because it being your own property, the RSPs have to be in first position only. So the other thing is, even if it was somebody else's money and you were using the 20% down, so again, Elliot, if you're using my RSP mortgage as the 20%, the bank is not going to allow you to go to 100% of the purchase price because they're going to consider that to be too risky. So the way I do it is I come up with the 20% cash through a line of credit. I may borrow money directly from somebody else and put it in my account for several months so that the bank, it appears from the bank's perspective that it is my money. I then buy the property with that 20% down cash, and then afterwards, a month later, I will have the property reappraised, and because you're an astute investor, you buy it below market value, so the appraisal comes in at a higher market value than what you paid for it. So your goal is that 90% of that new appraised value is going to be the equivalent to or equal to 100% of the purchase price that you bought that property for. So then I could place a second mortgage on that property. You still can't do it yourself because it's your money, your property. It has to be, if it's your money, it has to be in first position or it has to be on somebody else's property. But somebody else can invest their money on your property in that second position. So let me scroll down, make sure I answered your question correctly. Can I use my RSPs down payment? Yep, so that's it. So bottom line, you can only use your RSPs on your property if it's in first position and it's insured. Otherwise, it has to be somebody else's RSPs. All right. Good call tonight. Good turnout as well. Thank you very much, everyone. And look forward to seeing you on the next call. Take care. Bye now.